Question 1. Fundamental concepts. What is the key distinction between level term life insurance and decreasing term life insurance? A. Level term insurance has premiums that increase over time, while decreasing term insurance has constant premiums. B. Level term insurance maintains a consistent death benefit throughout the term, whereas decreasing term insurance has a death benefit that decreases over time. C. Level term insurance is only available to individuals under 50 years of age, while decreasing term insurance is available to all age groups. D. Level term insurance can be converted to whole life insurance at any time, while decreasing term insurance cannot be converted. Answer. B. Explanation. Level term life insurance is designed to provide a fixed death benefit that does not change over the life of the policy. In contrast, decreasing term life insurance has a death benefit that gradually reduces over the term of the policy. This type of policy is often used to cover debts that decrease over time, such as a mortgage. Understanding the differences between these two types of term life insurance is essential for selecting appropriate coverage based on individual financial needs. Question 2. Underwriting process scenario-based. Mr. Thompson has applied for a term life insurance policy and has disclosed that he engages in rock climbing as a hobby. During the underwriting process, which of the following actions should the underwriter take concerning this information? A. Approve the application without further inquiry since rock climbing is a common hobby. B. Reject the application outright due to the inherent risks associated with rock climbing. C. Request additional information about Mr. Thompson's rock climbing experience, including frequency, safety measures taken, and any previous accidents. D. Automatically classify Mr. Thompson as a high-risk applicant without further assessment based on his hobby alone. Answer. C. Explanation. In the underwriting process, it is crucial for underwriters to assess the risks associated with a prospective policyholder's lifestyle and activities. Since rock climbing poses certain risks, the underwriter should gather more information about how often Mr. Thompson participates, the safety precautions he employs, and any past incidents related to this hobby. This approach aligns with the principle of underwriting, which aims to evaluate the risk before making an insurance decision. Rejecting the application outright or classifying him as high risk without further assessment would violate the underwriting principles of fairness and thorough evaluation. Question 3. Claims process. During the claims process for a term life insurance policy, which of the following is not typically required by the insurance company? A. Proof of the deceased's identity and age. B. A detailed account of the deceased's medical history over the past 10 years. C. A copy of the death certificate. D. Documentation showing the policyholder's payment of all premiums up to the date of death. Answer. B. Explanation. While the insurance company may review the deceased's medical history as part of the claims investigation, a detailed account covering the past 10 years is not typically required. Essential documentation usually includes proof of identity and age of the deceased to ensure they were insured at the time of death, a copy of the death certificate to verify the event, and proof of premium payments to ensure the policy was in force. This understanding is crucial for navigating the claims process effectively, ensuring that all necessary documentation is gathered to support a timely resolution of the claim. Question 4. Policy provisions. Which of the following is true regarding the contestability period in a term life insurance policy? A. The contestability period lasts for the lifetime of the policy. B. Claims can be denied during the contestability period if the insurer discovers misrepresentations on the application. C. The contestability period begins once the insured reaches the age of 60. D. Insurers cannot contest claims after the contestability period, regardless of the circumstances. Answer. B. Explanation. The contestability period is a specific time frame, typically 2 years, from the policy's issue date, during which the insurer can investigate and contest claims based on misrepresentations or omissions made in the application. If misrepresentations are found during this period, the insurer may deny the claim. After the contestability period, the insurer generally cannot contest the claim except in cases of fraud. This understanding is critical for policyholders as it highlights the importance of providing accurate information during the application process. Question 5. Insurance principles. In terms of risk management, which of the following best describes the concept of risk transfer as it relates to term life insurance? A. Individuals take steps to avoid risk by engaging in safer activities. B. Individuals spread risk across a large pool of policyholders to minimize loss. C. Individuals shift the financial burden of their death to an insurance company by purchasing a policy. D. Individuals mitigate risk by purchasing additional coverage for high-risk activities. Answer: C. Explanation. Risk transfer refers to the process of shifting the financial burden of risk from an individual to an insurance company. By purchasing a term life insurance policy, the insured pays premiums to the insurer, who in turn assumes the risk of providing a death benefit in the event of the insured's death. This principle is fundamental to the insurance model, allowing individuals to protect their beneficiaries from the financial impact of their death. Question 6. Financial concepts. If a term life insurance policy has a face value of $250,000 and the annual premium is $1,500, what would be the cost per $1,000 of coverage? A. $5, B. $6, C. $7, D. $8. Answer: B. Explanation. To calculate the cost per $1,000 of coverage, you can use the formula text cost per $1,000 equal text annual premium text face value in thousands, applying the numbers text cost per $1,000 equals 1,500 250 equals 6.0. Thus the cost per $1,000 of coverage is $6. This calculation helps agents and clients understand the pricing structure of life insurance policies and allows for better comparisons among different policies. Question 7. Regulatory framework. Which Pennsylvania regulation must be adhered to by life insurance agents when discussing policy provisions with clients? A. Agents must disclose their commission structure to clients. B. Agents are not required to explain any policy provisions if the client does not ask. C. Agents must provide a written summary of all exclusions and limitations in the policy. D. Agents must maintain confidentiality regarding client information at all times. Answer: C. Explanation. Pennsylvania regulations require that life insurance agents provide clients with a written summary of the key provisions, including exclusions and limitations of the policy. This is part of consumer protection laws aimed at ensuring that clients have a clear understanding of what the policy covers and any circumstances that may result in a denial of claims, while maintaining confidentiality. Option D is also important. The explicit requirement to disclose policy limitations takes precedence in this context. Question 8. Market analysis. In analyzing consumer preferences for term life insurance, which factor is likely to influence younger consumers most significantly when selecting a policy? A. The financial stability of the insurance provider. B. The length of the contestability period. C. The premium costs relative to coverage amounts. D. The availability of riders and endorsements. Answer: C. Explanation. Younger consumers are often more sensitive to premium costs due to limited budgets, especially if they are just starting their careers or families. They typically seek policies that offer substantial coverage at low premiums, while factors like the financial stability of the insurer, option A, and policy features, option D, are important. The immediate cost of premiums is usually a primary consideration for this demographic. Understanding these preferences helps insurance agents tailor their marketing strategies and product offerings. Question 9. Claims process. Which of the following is a common reason for a life insurance claim to be denied? A. The insured's death occurred outside of the contestability period. B. The beneficiary did not provide the correct bank account information for payment. C. The insured committed suicide within the contestability period. D. The premiums were not paid on time. Answer: C. Explanation. Most life insurance policies include a suicide clause that may allow the insurer to deny a claim if the insured commits suicide within the contestability period, typically the first 2 years of the policy. This is designed to prevent adverse selection where individuals might seek insurance coverage with the intent of committing suicide. The other options listed are generally not valid reasons for denial, particularly if the insured was in good standing at the time of death. Understanding these causes is crucial for beneficiaries to navigate the claims process effectively. Question 10. Customer service and communication skills. When handling objections from a client regarding the cost of a term life insurance policy, which approach is most effective for an agent? A. Reassure the client that they can find cheaper coverage elsewhere. B. Provide a detailed breakdown of how the policy's benefits justify the costs. C. Ignore the objection and continue with the sales pitch. D. Tell the client that all insurance costs are high due to market conditions. Answer: B. Explanation. The most effective approach when addressing objections about cost is to provide a detailed breakdown of how the benefits of the policy justify the premium. This can include discussing the coverage amount, the financial security it provides to beneficiaries, and any additional features such as riders. Ignoring objections, option C, or suggesting the client seek other options, option A, undermines the agent's credibility and does not address the client's concerns. It's essential to foster trust and understanding by clearly communicating the value of the policy. Question 11. Fundamental concepts. Which of the following accurately describes level term life insurance? A. The death benefit decreases over the policy term while the premium remains constant. B. The death benefit remains constant throughout the policy term while the premium may increase. C. The death benefit and premium both remain constant throughout the policy term. D. The death benefit remains constant but the policyholder can choose to adjust the premium annually. Answer C. Explanation. Level term life insurance provides a death benefit that remains constant for the entire duration of the policy. The premiums are typically level as well, meaning they do not increase during the term. This type of policy is suitable for individuals who want predictable costs and coverage amounts over a specified period, often aligned with specific financial obligations like mortgages or children's education. Question 12. Policy provisions. Which policy provision allows the policyholder to reinstate a lapsed term life insurance policy? A. Grace period. B. Reinstatement provision. C. Incontestability clause. D. Accidental death benefit rider. Answer B. Explanation. The reinstatement provision allows a policyholder to reinstate a lapsed policy by fulfilling certain conditions, such as paying back premiums and providing evidence of insurability. Typically, there is a limited time frame, often within 3 years of lapse, during which reinstatement can occur. Understanding this provision is vital for policyholders who wish to maintain coverage after missing premium payments. Question 13. Underwriting process. During the underwriting process, which of the following factors is least likely to be considered when evaluating an applicant's risk? A. Age. B. Occupation. C. Hobbies and lifestyle choices. D. Current financial assets. Answer D. Explanation. Underwriters primarily assess factors directly related to the risk of mortality when evaluating life insurance applications. Age, occupation, and lifestyle choices, such as smoking or high-risk hobbies, are critical in determining an applicant's risk classification and premium rates, while current financial assets may be relevant in some contexts, e.g., for high-net-worth individuals, they are generally not a primary consideration in risk assessment for term life insurance. Question 14. Claims process. If a claim is denied due to an alleged misrepresentation made by the insured during the application process, what must the insurer provide to the beneficiary? A. A detailed explanation of the denial along with relevant evidence. B. A refund of all premiums paid. C. A second opportunity to contest the claim. D. An immediate payout of the death benefit. Answer A. Explanation. If a claim is denied due to misrepresentation, the insurer must provide a detailed explanation of the denial, including the specific misrepresentation and the evidence supporting this decision. Its transparency is crucial for beneficiaries to understand the basis for the denial and to consider their options for contesting the claim, if applicable. It's an essential practice under Pennsylvania insurance regulations that emphasize consumer rights. Question 15. Regulatory framework. According to Pennsylvania insurance regulations, what is the maximum grace period allowed for late premium payments before a policy lapses? A. 10 days. B. 30 days. C. 60 days. D. 90 days. Answer B. Explanation. Pennsylvania regulations generally stipulate that term life insurance policies must provide a grace period of at least 30 days for late premium payments. This means that if a premium is not paid by its due date, the policy remains in force for an additional 30 days. During this grace period, the policyholder can still pay the premium without losing coverage, which is a consumer protection measure to prevent unintentional lapses. Question 16. Ethics and professionalism. What is the most appropriate course of action for an insurance agent if they discover that a client has not disclosed a significant medical condition on their application? A. Inform the client that the insurer will likely deny the claim. B. Report the issue to the insurer immediately. C. Advise the client to fill out a new application with correct information. D. Ignore the situation as it is not the agent's responsibility. Answer C. Explanation. The ethical responsibility of the agent is to ensure that the application is accurate and complete. Advising the client to submit a new application with the correct information allows the insurer to properly assess the risk and provide appropriate coverage. This practice aligns with the principle of utmost good faith, Uberumi Fide, which mandates full disclosure from both parties in an insurance contract. Ignoring the situation could lead to severe consequences for both the client and the agent. Question 17. Market analysis. In the current Pennsylvania life insurance market, which factor has contributed most significantly to the growth of term life insurance sales? A. Increasing awareness of the importance of life insurance. B. The availability of customized policy options. C. The rising cost of permanent life insurance policies. D. Enhanced online purchasing platforms. Answer. C. Explanation. The rising cost of permanent life insurance policies has led many consumers to consider term life insurance as a more affordable alternative. As term policies offer low premiums for substantial coverage over a specific time, this trend has increased their popularity. While the other factors mentioned also contribute to the growth of term life insurance, the cost-effectiveness of term insurance in comparison to permanent options is a significant driving force behind its sales growth. Question 18. Calculations and premium determination. An insurer uses a mortality table to determine premium rates. If the expected mortality rate for a specific age group is 0.4, what is the annual premium for a $100,000 term life policy if the insurer wants to achieve a profit margin of 20% on the expected mortality cost? A. $80. B. $100. C. $120. D. $160. Answer. B. Explanation. First, calculate the expected mortality cost. Expected mortality cost face values mortality rate 100,000.4 for 100. To achieve a 20% profit margin, the insurer adds 20% to the expected mortality cost. Annual premium expected mortality cost to expected mortality cost x 0.20 400 400 x 0.20 480 480. Thus, the annual premium would be $480. Since this doesn't match the options given, it appears there's a misunderstanding in question construction, as the options presented were not formulated accurately based on the calculations provided. The exercise of adjusting rates according to mortality tables is essential for both insurers and agents in determining fair premium costs based on risk assessments. Question 19. Claims process. A beneficiary is filing a claim for a deceased term life insurance policy. Which document is NOT typically required to process this claim? A. Death certificate. B. Insurance policy document. C. Medical history of the insured. D. Claim form completed by the beneficiary. Answer. C. Explanation. When processing a life insurance claim, the standard required documents include the death certificate, the original insurance policy document, and a completed claim form from the beneficiary, while the insurer may review the medical history to assess the cause of death if necessary. It is not typically required as a document to file a claim. Understanding these requirements is crucial for beneficiaries to avoid unnecessary delays in the claims process. Question 20. Current issues and trends. Which trend is most likely to impact the future of term life insurance policies? A. Decrease in consumer awareness of insurance products. B. Shift towards artificial intelligence in underwriting processes. C. Increased regulatory restrictions on policy provisions. D. Decline in demand for term life insurance among young adults. Answer. B. Explanation. The shift toward artificial intelligence (AI) in underwriting processes is significantly impacting the future of term life insurance policies. AI can streamline the underwriting process, allowing for quicker assessment of risk based on vast data analytics. This trend enables insurers to provide more personalized pricing, which can attract more consumers. The other options are less likely to reflect current trends in the market, as awareness and demand for life insurance, especially among younger adults, are generally increasing. Question 21. Policy types. Which of the following statements accurately describes decreasing term life insurance? A. The death benefit remains constant while the premium decreases over time. B. The death benefit decreases over the policy term while the premium remains constant. C. Both the death benefit and the premium decrease over the policy term. D. The death benefit is paid only if the insured passes away before a specified age. Answer. B. Explanation. decreasing term life insurance is designed so that the death benefit decreases over the term of the policy, while the premium generally remains constant. This type of policy is often used to cover debts, such as mortgages, where the outstanding balance decreases over time. Understanding this concept is essential for clients looking for coverage that aligns with their diminishing financial obligations. Question 22. Riders. Which rider provides additional coverage for accidental death in a term life insurance policy? A. Waiver of premium rider. B. Accidental death benefit rider. C. Accelerated death benefit rider. D. Guaranteed insurability rider. Answer. B. Explanation. The accidental death benefit rider provides additional coverage that pays out an extra benefit if the insured dies as a result of an accident. This rider is popular among policyholders who want additional financial protection in case of unexpected accidents, enhancing the overall coverage of their term life policy. Question 23. Conversion options. What is the primary benefit of a conversion option in a term life insurance policy? A. It allows the policyholder to convert to a permanent policy without evidence of insurability. B. It guarantees the lowest premium for a permanent policy. C. It provides an immediate payout upon conversion. D. It allows for a higher death benefit upon conversion. Answer. A. Explanation. A conversion option in a term life insurance policy allows the policyholder to convert their term policy to a permanent policy without needing to provide evidence of insurability. This is beneficial for individuals who may develop health issues during the term and would otherwise face higher premiums or denial of coverage if they sought a new policy. Question 24. Tax implications. In Pennsylvania, how are the death benefits from a term life insurance policy typically taxed? A. Fully taxable as ordinary income. B. Exempt from income tax but subject to estate tax. C. Taxed only if the beneficiary is not a family member. D. Fully tax deductible for the policyholder. Answer. B. Explanation. Death benefits from a term life insurance policy are typically exempt from federal income tax, making them a tax-free benefit to the beneficiaries. However, if the insured's estate exceeds a certain threshold, the benefits could be subject to estate tax. Understanding these tax implications is crucial for financial planning and advising clients accordingly. Question 25. Term policy lengths. Which of the following is not a common length for a term life insurance policy? A. 5 years. B. 10 years. C. 20 years. D. 50 years. Answer. D. Explanation. Common term lengths for life insurance policies include 5, 10, and 20 years. While some insurers may offer longer terms, 50 years is not a standard length for term life insurance. Typically, the maximum term length for a term policy ranges up to 30 years, after which the policyholder might consider conversion options or other insurance products. Question 26. Health underwriting. Which of the following is not typically a factor considered in health underwriting for term life insurance? A. Family medical history. B. Current medications. C. Educational background. D. Smoking status. Answer. C. Explanation. Health underwriting for term life insurance typically includes evaluating family medical history, current medications, and smoking status, as these factors can influence the insured's risk profile. Educational background, while relevant in some contexts, is not a standard factor in determining life insurance premiums or coverage eligibility. Question 27. Policy delivery. When delivering a term life insurance policy to a client, what is the primary document that the agent must provide? A. An application form. B. A copy of the underwriting guidelines. C. The policy summary. D. A list of available riders. Answer. C. Explanation. When delivering a term life insurance policy, the agent must provide the policy summary, which outlines the key features of the policy, including coverage amount, premium payments, and any riders attached. This document is essential for ensuring that the client understands their policy's terms and benefits before accepting it. Question 28. Incontestability clause. What is the standard duration for the incontestability clause in Pennsylvania term life insurance policies? A. 1 year. B. 2 years. C. 5 years. D. 10 years. Answer. B. Explanation. The incontestability clause in Pennsylvania typically lasts for 2 years from the policy's issue date. This clause prevents the insurer from contesting the validity of the policy based on misstatements or omissions in the application after this period, providing security to the policyholder and beneficiaries. Question 29. Policy exclusions. Which of the following would typically be an exclusion in a term life insurance policy? A. Death from natural causes. B. Death from suicide within the first 2 years. C. Death from accidental causes. D. Death from an illness diagnosed after policy issuance. Answer: B. Explanation. Most term life insurance policies include a suicide exclusion, which typically states that if the insured dies by suicide within the first 2 years of the policy, the death benefit will not be paid. This exclusion is designed to mitigate the risk for insurers as it helps to prevent potential misuse of the insurance policy. Question 30. Beneficiary designation. If an insured person fails to designate a beneficiary in their term life insurance policy who will typically receive the death benefit: A. The insured's estate. B. The insurer. C. The insured's parents. D. The insured's siblings. Answer: A. Explanation. If no beneficiary is designated, the death benefit from the term life insurance policy typically goes to the insured's estate. This can result in the benefit being subject to probate and potential estate taxes, which may not be the most efficient way to distribute the proceeds. Advising clients on the importance of designating beneficiaries is crucial in ensuring that their intentions for the policy proceeds are honored.